Did you know that most seniors living on Social Security are unknowingly leaving hundreds, sometimes thousands, of extra dollars on the table every single year? Not because of bad luck, and certainly not because they aren't hardworking or deserving, but simply because nobody ever sat them down and explained the rules of the game. If you are watching this right now, that changes today. Welcome, friend. You have worked hard your entire life, and you deserve every dollar that is rightfully yours. So go ahead and hit that like button, subscribe so you never miss a helpful update, and drop a comment below telling us, how long have you been on Social Security? We would love to hear your story. Now, let's dive right in, because what we're going to talk about today isn't just interesting, it's genuinely life-changing for a lot of people. And I want you to picture someone for a moment. Her name is Margaret. She's 67 years old, lives in a cozy little home in Ohio, tends her garden every morning, and gets a Social Security check each month that she stretches like a pro. She clips coupons, cooks from scratch, and rarely splurges. Sound familiar? Maybe it sounds a little like you, or someone you love. Margaret always assumed there was simply nothing more she could do, that the number on her check was final, fixed, and forever. But one afternoon, her neighbor Carol, who had recently retired from working at a bank, sat down with her over a cup of coffee and said, "Margaret, have you ever actually looked into whether your Social Security amount is correct?" That one question changed everything. Because here's what most people don't realize, Social Security is not just a simple number that gets handed to you. It is the result of a formula that can be influenced, adjusted, and in many cases, genuinely improved. And the first place to start is something that sounds almost too simple to be true. If you haven't begun claiming your benefits yet, the single most powerful thing you can do is wait. For every year you delay past your full retirement age, which for most of you watching is somewhere between 66 and 67, your monthly benefit grows by roughly 8%. 8% per year, guaranteed, for life. That is not a Wall Street promise or a risky investment. That is a rock-solid increase backed by the federal government. If you can wait until age 70, you could be receiving a check that is 24 to 32% larger than if you had claimed at your full retirement age. Think about what that extra money could mean: more groceries, less worry, maybe even a little something set aside for the grandchildren. But let's say you are already claiming. Or maybe you worked hard for decades but not quite 35 years. Here's something the SSA doesn't exactly advertise on a billboard: your benefit is calculated using your 35 highest earning years. If you worked fewer than 35 years, those missing years are filled in with zeros. Zeros. And those zeros drag your average earnings down, which in turn drags your monthly check down. So if you are in a position where you could work even part-time for a few more years, perhaps a friendly retail job, some consulting, or even helping a neighbor with errands, those working years can replace those dreaded zeros and actually raise your benefit permanently. It's one of the most overlooked income-boosting strategies out there. Now here's something that gets Margaret, and honestly, a lot of people, genuinely fired up. Mistakes. Errors. Blunders in your official Social Security earnings record. This happens more often than you might think, especially for folks who change jobs frequently, worked for smaller employers, or had gaps in employment. If your employer didn't properly report your wages, or if there was a clerical error somewhere along the way, your benefits could be lower than they should be, and you'd have no idea. The fix is straightforward, but you have to take action. Visit ssa.gov, create your free account, and look at your earnings history year by year. If anything looks wrong, if a year shows lower wages than you know you earned, report it immediately. Getting that corrected can boost your benefits for the rest of your life. Consider it your personal audit, and think of it as money you've already earned just waiting to be reclaimed. Now, let's talk about something that brings a lot of comfort to people who may not have earned high wages throughout their careers. Spousal and survivor benefits. If you are married, or if you were married for 10 or more years before a divorce, or if you have been widowed, you may be entitled to benefits based on your spouse's or ex-spouse's work record, not your own. A living spouse's benefit can give you up to 50% of their full benefit amount. And for those who have lost a spouse, survivor benefits can be as much as 100% of what your partner was receiving. This is one of the most emotionally meaningful provisions in the entire Social Security system, and it's one that far too many people never pursue simply because they didn't know it existed. Here's another remarkable option that most financial advisors don't bring up nearly enough: benefit suspension. Let's say you claimed Social Security at 62 because you needed the income at the time. Life happens, and there's no shame in that. But now you've reached your full retirement age, and perhaps you've taken on a part-time job or received an inheritance, and you're not as dependent on that monthly check anymore. Did you know you can voluntarily suspend your benefits? When you do, you start earning those 8% annual delayed retirement credits all over again, right up until age 70. It's like pressing a pause button that also works as a fast forward, because when you restart at a significantly higher amount. It takes planning and some financial cushion to pull off, but for the right person, it is a genuinely brilliant move. Now let's address something that quietly frustrates many seniors, and that is taxes. Did you know that up to 85% of your Social Security benefits could be subject to federal income tax? It all comes down to what the IRS calls your combined income, which is half of your Social Security check added to your other taxable income. If that number exceeds $25,000 for an individual, or $32,000 for a couple, the taxman starts taking a bite. One smart way to reduce this is to draw from a Roth IRA, because Roth withdrawals are tax-free and don't count toward the combined income figure. If you haven't set one up yet, it may be worth talking to a financial advisor about your options, because keeping more of your Social Security away from the IRS is just as good as earning more of it. And speaking of income, let's talk about children. If you're receiving Social Security and you have children under the age of 18, or 19 if they're still in high school, those children may be eligible for benefits on your record. This can add a meaningful temporary boost to your household's total monthly income while your kids are still growing up. It's a lesser-known provision, but an important one for grandparents raising grandchildren or for parents who had children later in life. For those who claimed early and are now having second thoughts, there's even a do-over option. If it has been less than 12 months since you first filed for benefits, you can submit what's called a withdrawal of application. You'll need to pay back every dollar you've received so far, which is certainly not easy, but once you do, your application is reset entirely. It's as though you never claimed at all, and your benefit can continue growing as if those months never happened. This is a once-in-a-lifetime option, so it requires serious thought, but for someone in the right situation, it can be enormously valuable. Beyond Social Security itself, there's wisdom in building what financial planners call passive income streams, money that flows in without requiring your daily labor. Dividend-paying stocks, real estate investment trusts, known as REITs, renting out a spare room or even a driveway or storage space in your home, or setting up an annuity that provides guaranteed lifetime payments in exchange for a lump sum. These income sources don't count against Social Security's earnings test, which means they don't reduce your monthly check. They simply add to it. Think of them as quiet little helpers working alongside your Social Security, doing their job while you enjoy your morning coffee. And on the subject of the earnings test, this is crucial for anyone who is still working before they've reached their full retirement age. In 2025, if you earn more than $23,400 a year from work, the SSA will begin deducting from your Social Security check. Now, the good news is you do eventually get that money back in the form of a slightly higher benefit later. But in the short term, it can feel like a punch to the wallet. The workaround is either to keep your earned income below that threshold, or, even better, simply wait until you've reached full retirement age before ramping up your work hours, because once you hit that milestone, the earnings test disappears entirely. Margaret, by the way, sat down with a Social Security specialist after that conversation with Carol. She discovered an error in her earnings record from 1989, had it corrected, applied for a spousal benefit she hadn't known she was entitled to, and began drawing from her small Roth account to keep her taxes manageable. Her monthly income didn't double overnight, but it grew in a way that gave her genuine breathing room for the first time in years. She started sleeping better. She stopped saying no to Sunday dinners with her grandchildren. Small things, maybe, but to Margaret, they meant everything. And that is exactly the kind of transformation these adjustments can create in a real life. Not just numbers on a page, but peace of mind, dignity, and the freedom to enjoy the years you have worked so hard to reach. We've covered a lot of ground today, and there is still one more piece of the picture I want to share with you, something that ties everything together and can help you move forward with a clear, confident plan starting today. Stay right with me, because we're almost there.